Welcome back to CMG Oral Space Forex Lessons. This is a complete playlist for forex trading. In fact, for beginners. So if you're a beginner, this is the best, one of the best videos playlist for you, right? We have treated a number of them, and then this episode will be the last but one, hopefully. In fact, the last but one episode. And so thank you very much for sticking with us. We really appreciate your efforts, your dedication, and you actually what make it if you should continue with this attitude, this positive attitude. In the recent video, we looked at tips and spreads, right? So when it comes to forex, these are the very important basic things that you have to know. You have to really understand to actually be profitable in this thing. In this profession, I should say. So, in this episode, we are going to look at contract size and the lot size. This is very important, right? It's equally important as the pitch and spread that we did in the recent video in episode 13. This is episode 14. So please be mindful of that. So it's a good thing that you actually understand this. Now, sometimes this is very basic, yet it can be a bit confusing when you are especially a novice, right? An amateur, and then you are beginning to learn forex, right? So, in as much as it may sound confusing and difficult, right? I'll find better analogies to make it simpler for you to understand. So just stick with me. So for starters, you already know that when it comes to forex or forex trading, there are only two typical activities, operations that can actually be done in this profession, right? And then they are buying and selling, right? Only buying and selling. These are the two operational activities that can be actually done in this profession, right? And then someone may ask, we have already done that also, that what do we actually buy and sell? In forex, we only buy and sell currencies. And these currencies are not bought individually. We buy them or sell them against one another. That's when the economy of a nation, right, becomes stronger than the other or weaker than the other. So we forex traders or retailers, we are only benefiting from these differences, right? The spreads and then yes, the exchange rates. We are only benefiting from this, right? So this is what we do. Now, when you move to the market or go to the market and you are going to buy or sell, these things are actually what? Bought or sold in what? In some quantity, in some units, right? There's a standard of what? Buying or a standard of selling, right? So when you go to the market, you just don't go with money and then you do whatever you like. There's a way or there's a standard that you have to actually what? Observe, obey in order to actually come out successfully, right? So these things are what? Bought or sold in what? In units or in quantity, right? Now, these units are what we term as what? The lot size, or better still, contract size in another fashion or in another profession, yet similar, right? So they are just similar. In many a time can be used interchangeably, but for you to be specific, right? You can actually draw a small difference between the two, right? It's based on what? So in forex, contract size can be termed as what? A lot size. But in the other stocks, futures and options and all that, they can be actually draw some distinction between the two, right? So that is what I have to inform you before we start, so that you don't get confused, right? So we are saying that we buy them or we sell them in units, in quantity. So let me give you an example, a simple example. So when you go to maybe you're a woman or whatever, better still a man, and you go to buy some undies, right? Especially boxes of panties. These are usually what? Sold or bought in what? In dozens. right? So a dozen contains how many punches? 12. You understand? It's as simple as that. This is one example. Now, another example is when you go to the filling station, right? Or the gas station, the Americans will call it a gas station. I'm from Africa. In fact, I'm an African. So we call it the fuel station. Yeah, right. So when you go there and you want to buy fuel, or better say petrol or super, we call it, you give them some money, right? You tell them I want to buy maybe 50 cedis, right? Now, these 50 cedis, the attendant will not give you the 50 cedis, right? Back. But there's a conversion. The key in what? Maybe your amount, and sometimes this can also be what? Keyed in as the liters. So you give them the money and they give you the fuel in terms of liters. So you understand? So we are talking about the units, right? So you give them the money, and then they give you what? The fuel in terms of liters. So that is how it is. So when you go to the fuel station, you buy what? The fuel in liters. So that is it. So that's the units of measurement. So that's what it gives you. So in the same way, when it comes to the forex, I can even use forex and then in the traditional way that when you go to a forex bureau, right, to change convert some currency, let's say from dollars to cedis, right? When you go and you have let's say 50 what $50, right? Now in the $50, we have a number of what dollars in that in it, right? You don't go there and go and change only $1. You hardly see a customer going to the forex bureau to change $1. You understand? So we have a number of dollars in that 50, and then they'll give you that. So you go there to buy the units or sell the units, and then they give you that. So I think with this idea, you understand what you are talking about. So when you go to the forex market to buy or sell, whatever you are doing, you're buying, you are doing that in terms of lots, right? You are doing that in terms of lots. So you hear something like lot size 1 or 0.1, 0.2, 5, 4, right? So that is what you are doing. You buy the currencies in that, or you sell them in that unit. So that is what we are talking about. That is the overview. I hope that. So when I come to the reading, I may not talk a lot, but you have the idea. So that is it. So now let's look at it. Now, lot size is the amount or quantity of a trade that you bought or you sold, right? It's the quantity, it's the amount or the quantity of trade that you bought or sold. It is sometimes called your position size or the trade size, right? So I think you're following. Now in forex markets, these currencies are not bought or sold singly. I just told you, right? You buy them in what? In quantity. Now they are bought and sold in packs. So these packs is called what the lot size or lot size. That is what makes the gain appreciable. So the number of units, then you multiply by whatever it is, then you actually get appreciable amount, right? A good amount, a good quantity, a good yes, that is it. Now, so if your profit is if not your profit in forex would have been just a small amount of dollar or something like that. That's all. Now, because you buy this currency in bulk, right, or packs, known as lot size, that is why the gain is appreciable. So now you understand. So now we are going to look at the types of lot sizes, right? So like we said, we buy this in terms of lot sizes or better say contract size. Now, these contract sizes, or better, so let me just stick to lot size so that you don't get confused. Now, the lot size have different types. We have different types of them, right? You understand? So even though all these parts or lots, the lot sizes are bought in this quantity, whatever in units, we have different types of them, right? So that is what you have to know. Now, with this type, we have standard lot size, and then we have the mini lot size, and then we have the micro lot size. There are some other lot sizes that there, but usually these are the standard that we usually trade in, depending on our account sizes. You understand? So bear in mind, the standard lot size, we have the mini lot size, and we have the micro lot size. So let's read let's read more about this. Now, the standard lot size, right, contains 100 units, right? contains 100 units, and it is represented by a lot size called what? 1.0. You understand? 1.0 lot. So one lot size contains what? A unit of 100,000 what of that currency that we are talking about. 100,000 pieces, right? 100,000 pieces. Let's use the pieces. 100,000 pieces, right? That is it. One lot size contains 100,000 units of that currency. So example, like I gave in the panties and then the lingerie, whatever. We have a dozen. A dozen contains what? How many pieces of it? We have 12 of them. So that's what we're talking about. In the same way, that is applicable to the mini lots. So the mini lots is what? It's 10,000 units, and it represented by the lot size at what? 0.1, right? So, and then 1,000, 0.01, and then the nano lots, 100 units, and it's what represented by 0.001 as indicated. You understand it? I think this is easy to understand. This is lucid, right? So that is it. Now that we know this, let's continue. So with this idea, I told you that many a time, the contract size can interchangeably be used with lot size, unless you want to be more specific in other fashion, like the futures, options, and the stocks, right? Unless you want to be more specific. So let's throw more light on this, right? So what I can tell you now for it to be easy for you is the units that we are talking about, the units being contained in a lot size, right? Uh, is simply what the quantity the quantities in it, right? So that is so in another person you can just say that the contract size is the units in the lot size, right? So it's as simple as that. So let's read and see if we can get some clear differences between this, right? So let's go to now. When trading in the financial markets, investors should have a basic understanding of the fundamental terms and concepts involved, right? Now, contract size, right? That's what we are talking about. Contract size refers to the number of units. So you understand? The units in lot size is termed as what? The contract size. I hope you understand. The units in the lot size that we are talking about is termed as what? The contract size. It's as simple as that. So that's what you're talking about. So which it refers what? It refers to the number of units of financial instruments, right, that are included in a single contract. It is a critical element of trading that is used to calculate the value of a position, right, and then determine the margin requirements. Now, understanding contract size is essential for traders as it can impact their positions what profitably, and then it can what impact their positions profitability and then the risk, right? So you have to understand this. A lot of the amateurs or the novice, I should say, they are trading. They are being introduced by some other mentors and from other teachers, right? And like I told you, many of the teachers like us will not have time to take you through this contract size and that. Some of them, if you're a serious student, you have to go start doing the practicals or start doing the training. And then if you're a serious student, you come and ask, I've really encountered this. What does it actually mean, right? These are only found with the serious student. If you're not a serious student, you will just go with the flow, right? Of course, I'm not saying that you actually need this to be profitable. You need to understand it to be profitable. No, if you are being introduced to forex and then the tutor just introduced you what is lot size, right? And then tells you how much you want to risk and how much you want to lose in the trade. I think that one that one is enough. Yes, that one is enough. But here's the point, I am a teacher, and then my way of learning is to make sure I understand whatever is going on. Everything in that profession, everything in that discipline, I have to understand it. That is how I learn, right? I don't take things for granted because it's the understanding of the rudiments that actually makes me become what? An expert. That is me. So that is it. So understanding contract size is essential for traders as it can impact their positions, profitability, and then the risk. Now, the contract size varies across different financial instruments. When you say financial instruments, it's just the currency that we are talking about, the pairs that we are talking about, or whatever you are trading, right? And its value is determined by the exchange rate or market where the instrument is traded. For example, in the forex market, the contract size is typically expressed in lots. This is a very important point to note, right? Let me take this paragraph well. Now, we are saying that the contract size varies across different financial instruments, right? We saw something of that sort in when we were calculating the peak value. We said that the peak value actually a difference from one currency pair to another. We said that. It's a similar thing here, right? So the contract varies across different financial instruments, and its value is determined by the exchange or the markets where the instrument is traded. For example, in the forex market, the contract size is typically expressed as what? Expressed in what? In lots. So now I think the air is clear here that I that in forex the contract size is just the units in lots, right? So some people use interchangeably unless you want to be a pro, right? So that is what we are talking about. So now I think the air has been cleared here. That the contract size is typically expressed in lots, right? With the standard lot representing 100,000 units of the base currency. We saw this the base currency and then the code currency. So if you have forgotten about this, just check the recent video, episode 13, and you know what the base currency and then a code currency, right? So the standard lots representing what? 100,000 units of the base currency. So in contrast, in the commodities market, right, the contract size can vary depending on the commodity traded, right? So in this financial market, we have a number of them, different types of financial markets. We have the forex, we have the futures, we have the options, we have the stocks, we have the stock, in fact, the stock indexes. We have these things. Yes. So if you don't know, forex is not only the digital assets or the financial market that is traded, right? We have a number of them, but we are being specific on what forex. So I hope you get the picture now. Now, this is just a takeaway, like a take home. I decided to just add. Sometimes learning without the tutor or being taught the importance of that can just be you can just you really appreciate it, right? So sometimes whatever is being taught, whatever is being explained, I like to give the importance of that, the benefits, or why is that, right? Because I wouldn't waste my time on learning something that I wouldn't benefit from. That is how I learn, right? So some of them I'll just add them as a take home, right? So now let's see the importance of contract size. Why is it important? Even know contract size, right? Now, contract size can impact the amount of money required to open a position, right? It can impact the amount of money required to open a position. We did that similar to the margin, right? We did margin and then we did pre-margin, margin level, we did the equity, and then we did the balances, right? And that is in episode what? 12. You can check that out. So that is it. So the larger the contract size, the more significant the initial investment required to open a trade. So for example, if a trader wants to trade one standard lot of Euro USD, they would need to have at least $100,000 in their trading account. So if they don't have this, that is where the term called leverage will come into play. We have done that in episode 12 still. Now, the second importance is that contract size and in fact the amount of profit or loss generated by a trade. Depends if your profit will be higher or your loss will be higher or lower. It depends on the contract size that you are trading, or better say the lot size that you are trading. Now, the larger the contract size, the more significant the profit or loss generated by a trade. For example, if a trader bought one standard lot of USD at an exchange rate of 1.1500 and sold it at 1.1600, but that you do the calculation in terms of it, the differences, right? And then you find that is still done in episode 13, right? They would make a profit of $1,000. You understand? That is it. Now, some brokers offer the option to trade fractional contracts, right? Fractional contracts. Like we said, from the onset, we said that whatever transaction that you do, they are in terms of what? Contracts or lots. And the lots are standard, right? They are standard. But beside this standards that is being set, right? Some brokers can actually find a way around it. I told you the brokers are our gateway to the market, right? Without them, we wouldn't be able to do anything. So they try to make things easier, right? Things accessible to us so that we can actually trade and then benefit in some way. So this is even one of their functions that they do, right? So some brokers offer the option to trade fractional contracts. It means that even if our amount is not, it does not meet a particular contract size, they find a way around it to give us, yes, that is it. Which allows traders to open smaller positions than the standard contract size. This can be beneficial for traders who have smaller trading accounts, right? Or want to manage their risk more effectively. So some may have a bigger account size, but they want to minimize their risk. Hence, going in for a very minute lot size. So you can actually capitalize on this for your benefit. Now, point 4, the contract size can vary depending on the type of account to the half. This is actually found in point 3. You can actually find that in point 3. For example, some brokers offer mini accounts that allow traders to open smaller positions than the standard contract size. This is very true. When you are opening an account, for that matter, a real account, there are some different types of account, real accounts that you can trade. For example, Exchange has about 4 types of real accounts that can be created. It all depends on what your contract, your account size, how much you are going to trade, or how much is going to be deposited in your account. You understand? So this is the importance of understanding our contract size and lot size. Now, we will actually attend to this, how to trade with this lot size in the practical sense. This is like more like a theoretical aspect of it. So understanding it is very important. So when it gets to the practical aspect in the advanced classes, you understand. So in the advanced, we have the 3 packages, right? We have the beginners, we have the intermediate, and we have the advanced. Now, what we do in the advanced is purely practical, right? Practical, whatever we have learned, we put into practice, right? And then give you some tips, guiding you, mentoring you. So that's what we do in the advanced class. So that is so. In summary, contract size is an essential concept in trading that can impact a trader's profitability and risk. Traders should have a good understanding of contract size and how it applies to the financial instruments they want to trade, right? So let's have some pictures of the type of the contract size, or better the lot size that we are talking about, right? So we have the standard, we have the mini, we have the micro, and in fact we have the nano, right? So in this picture, starting from the smaller one, then we go up to the standard, right? So each of them, the type, has the number of the units under them, right? For the 100,000, for the standard lot size of 1, right? The lot size can also be what? Termed as what? Volume. Now today we are learning some new terms. Please, I hope your writing file is what is available. Take note of these things, right? Volume is another term for lots, right? So that is it. And then the units, right, is another term called the contract size. I hope you understand this. Units is what contract size in terms of what? Forex. Let's put it that way. And then the lot is what? The volume. Now there's a third column called what? Dollar per pip, right? So what it means is that per the lot size that you are trading, a pip will cost how much, right? That is what it means. So someone who is trading a standard lot size, right, and then with the same number of pip, the amount that would actually be realized will differ from someone who is trading the mini lots, right? So in the standard lot, one pip would be what? $10. Now in the mini standard lot, right? Which if you should go 0.10, the amount that will come out for a pip is what? Is $1. Now when you take the micro lots, right? We are still dealing with the number of pips. Bear in mind, we are dealing with the same pips, right? Let's say 10 pips, right? We are doing the same thing. But in this case, we are talking about 1 pip. So here we are also is the same thing applicable, unless the pip differs. But we are using 1, then we can do the conversion ourselves. That's what we are doing. So a pip in the standard lot is $10. A pip in the mini lots is what? It's $1. And then a pip in micro lots is 0.1 cent, right? And then the nano is 0.01%. I hope this is easy to understand. I hope you got a picture here. It's as simple as that. Don't try to complicate things here. This is it. This is it. In fact, I've really simplified things, right? Now, if you have forgotten about what's the pip value, what pip value is, then you have to just check episode 13, right? We did the pip value calculation there, right? So you understand what a pip value is. There's a calculation there. Now, notwithstanding this calculation, I'm just trying to make you understand what's the mean. But we have some sites that have actually made this very easy for us, right? I will still put the links in the description. We have my Forex book, right? They do that. When you go there, all the different types of calculation are there, right? A pip calculation, whatever standard lots, and then the contract size and everything. It's just a matter of putting in the lot size and then the pip distance. Just put there, and then we hit just with a click. You have the calculation result populated. So it's easy there. So you realize that you wouldn't have to worry yourself doing this individually, doing this. This is very difficult. So it's just a matter of knowing the contract size you are trading, and then the lot size you are trading, and then the pips that you are you actually want that currency to move either up or down, right? So that's the site will do that calculation for you. So I'll put that in the name, right? So I think this is well understood. So these are just examples here, right? I'm not going to waste my time in reading them. You can be pausing the video like I did in the other episode. You pause, you read, right? You pause, you read. I don't want the video to be lengthy. You just pause it. You read, you pause, and you read. So that is it, right? Then you come here to the same thing. There's just another representation, right? The standard lot has a contract size, right? Standard lot has a contract size of 100 units. And then the standard lot is what? One lot or one volume. And then for the standard notes, right, 1 pip is what, $10. And then that's what it means. Dollar per pip. 1 pip is $10. And then here to 1 pip is $1. The 1 pip is 0.10 cents. And then here 1 pip is that. You understand? So the same thing, just another description, explanation done here. We just going through, we pause the video and then we go through, right? I think this is clear, right? So thank you very much for watching this episode. Please like, subscribe, and share. If you have any concerns, please let us know. Either you write to us, text, whatever. You can check in our page description, and then you can get back to us. If you want one-on-one lessons, private lessons, we provide that. You actually guide you, be your mentor. If only whatever you are providing here is good for you, if you really appreciate it. So thank you very much. See you in the next episode. Bye.